also share a little bit more about today's workshop.
Thanks. The train's gone now. Thank you, John. So I'm Chris Linder. I'm the Loan and Outreach Officer for Cooperative Fund, covering all of Maine. So we're really excited to have you all here today. And we really hope this can become a tool for not only to help you all who are learning about financial statements, but also to help interpret and help others digest financial statements. And this will be recorded, so you can share this out afterwards too. So basically today we're going to cover what are the three basic financial statements, and also some hints on how, in terms of presenting them to different stakeholders, employees, owners, boards, finance committees, how you might want to do it a little differently. At the same time, how to create a financial statement, very basics. And then, like I said, communicating about financial statements to diverse audiences.
And I'm Rebecca Fletcher. I'm also a loan officer with Cooperative Fund of the Northeast. I have the same job as Chris, but further south in Western Mass and Western Connecticut. And so whenever we talk about money, we bump up against the fact that there are a lot of societal taboos about talking about money. So I just want to start by addressing this a little bit. Not talking about money doesn't benefit the working class. When parents hide their money conversations from their kids, it's harder for kids to learn about money, about how to get it and how to manage it and how to use it to accomplish their goals. And not talking about money as people are adults really supports the wage gap and other things that we don't like, right? So as you educate yourself and as you talk with and educate folks within your co-op about money stuff, you might bump up against kind of, fears about the unknown that money brings up. People have past traumas related to scarcity around money and various types of discomfort with talking about money matters openly. So in light of this, I want to run down some of the benefits to your co-op of having increased literacy, financial literacy among your membership. I talked to one board member about this question of like, what benefits did you get from like working on financial literacy training with folks in your group? And he said, everyone thought they could just be paid more money. Like we were having a lot of this like buzz around the staff of like, why can't we increase wages? And so we had to do a bunch of financial meetings so everyone could understand like where the money is going. So we can definitely offer a reality check. Talking about the money piece of things, building literacy among your crew can really show people how what they're doing connects to the bigger picture and help people build pride in how their piece is part of something greater and how these little decisions that the co-op's making kind of add up to these bigger outcomes. It can build people's capacity in their personal life. They often don't have, a lot of people don't come to their business with really good handles on how to do stuff in their own lives, and it can stabilize their home situation a lot with cars and housing and that kind of thing. Redundancy is a big deal for co-ops, I know, and having like the more people that know about how to read the balance sheet, how to understand the P&L, what's going on, the more you protect against fraud, because people are looking at and understanding the numbers. You're not dependent on just one person, and if there's turnover, you don't have this huge risk of a bunch of information leaving with one person And then you really cultivate potential board members as you build capacity for members to engage meaningfully with the numbers. And for some businesses where there's like a bifurcation between the folks in the office and the folks who are in operations on the floor, maybe, you know, in the cafe, there could be having an ability to have more people understand the numbers and interface with them can really kind of knit together those two groups better. And then lastly, you know, none of us is as smart as all of us. And the more people you have looking at the numbers, the more good ideas can come from different corners of your business, from different people who wouldn't have been able to provide those before. Johan, you can go on to the next slide. So I know that a lot of you are working with reports regularly. I know there's some GMs and some bookkeepers and folks in the mix here hiding. And I'd be really interested to understand what you're working with most often, what statements and reports or, you know, spreadsheets are sort of your go-to tools. And this you can be looking at, you know, actuals reports, or if there's like a projection that you use all the time or fill actuals into. If you want, yeah, totally. Thank you you can stick stuff in the chat. Perfect. And you can also raise hands or come off mute. All those are good ways of connecting. I can't see everybody, so coming off mute is totally appropriate. So QuickBooks and Excel sheets. And how about like any specific reports that are kind of your, you know, any comparison that you go to all the time? Karen's saying the same.
I feel like, hey, how y'all doing?
Hi.
Hey, I feel like right now, we're just literally got our books together.
Yep.
So we're always looking at like how much it costs us to run our studio programming. And I think that the accountant was able to take all the older kind of like Excel sheets that we did our best to track down the finances and stuff. And we hired a bookkeeper to get the QuickBooks stuff in order. So now we're kind of in a better place to be able to pull up a report of how much like our profit and loss statement for running Dorchester Art Project here in Boston. But like we're literally just was able to do that last month. So before that, like I said, we were using like a lot of Excel sheets and maybe meeting every 2 weeks or once a month to try to plug the information in, or we were doing it in retroactively.
Great, awesome. Good. Well, it looks like there's a lot of commonalities here. Everyone's checking P&L, some people's quarterly, different amounts of time. I saw somebody was looking at a cash flow projection all the time. All right, so good. Thank you guys. We can move on, Johan, to the next slide. I want to talk about the chart of accounts to start us off too, because it's kind of the building blocks for all of the reports that we create. So the chart of accounts, you know, it's a list of all the categories in the business's financial ledger, and it organizes all of those different accounts into the type of account they are. Can anyone give an example of a liability account?
Any
Okay.
short-term or long-term debt?
Yeah. Yeah. And how about a like a type of equity? Does anyone have an example of like one account that's an equity account on in your QuickBooks?
Member equity.
Yeah, great. Good. So it breaks them all out into these different types. Each account and subtype has its own account number, so they're kind of all organized You can see whether something is an asset or a liability typically by the number that it starts with in your particular ledger. And then for your assets, the ones that are the easiest to turn into cash are on the very top of your balance sheet. So cash is always your most liquid asset, and then accounts receivable, then inventory, equipment, and vehicles, with real property being towards the bottom because it takes the longest to move into liquidate into cash. And I think the other thing that I want to mention here is that it's really important as your chart of account gets set up, in case anybody doesn't have one set up yet, if you're at the very beginning, if there's any launch businesses here, you really want to have professional help doing it, because you want to make sure that any product or department that you want to be able to analyze the profitability of, that you can break those out in your chart of account. Somebody just mentioned this a minute ago, like trying to make sure it could do the reporting for you that you need. So you can run separate P&Ls for each type of thing. Like if you have wholesale versus catering, you want to be able to distinguish that in your income. If you have a craft brewery co-op, you might have different types of beer, and you might want to be able to analyze the profitability of each one of those separately without them being all smushed together. Johan, I'm ready for you to move on to the next one. I think it is Chris.
Yeah, so instead of us sort of presenting these different reports, we thought we'd just kind of walk through a group exercise together to build the financial statements as a group of a hypothetical brand new farm that does not exist yet, but we will create it. And while we create it, we're going to create the financial statements together. So if we could start, and same with the first question that Rebecca posed, if folks just want to either type in the chat, raise your hand, or come off mute to answer this question. So the first statement that we're going to build together is the profit and loss, or the income statement. So what I'm looking for is, what are the not necessarily big ticket or large things that we need to buy that will be with us for many years, like a building or a car, but what are the seasonal types of purchases or expenses, cash out, that we need to think about for this? Right now we're about to start planting, right? It's the spring, summer. So what are the types of expenses that we're going to need to spend to both grow our products and then sell our products by the end of the year? And just to sort of popcorn throw out different expenses.
Electricity, gas, rent, on and on.
Yep.
Insurance,
Mhm.
Marketing, advertising,
Awesome.
booze.
Yep. And in the chat, I see seeds, plants, fertilizer, fuel, seeds, fertilizer, fuel, taxes. Absolutely. Seasonal labor. Yep. Thank you. Hired help. Yep. Insurance. Yep. Great. These are all really helpful. I don't know if anyone from the Spanish translation had any, Erica or Carolyn. Rent. Yep. Great. Well, we can, so with that, let's start to build our profit and loss. So in our hypothetical farm, And these numbers, I apologize, there's another train. I'm really sorry. Um, we all mentioned seeds and feed, which are input supplies, livestock. They're non-dairy, so we are growing them to sell them. Labor and help. The important part of any business is to remember yourself. Oh, good. You can't hear the train. Good. Yeah. So always remember to pay yourself too, not just the employees. Fuel, electricity and water, bank interest. Yep. We may have to borrow money. And depreciation. I wanted to spend a little bit of time on depreciation. Depreciation is usually through your profit and loss is usually the only item that is not cash related. Depreciation recognizes when you buy a big ticket item like a building or a car that it's going to be with you for many years. Basically, if it's going to have the life of 10 years, you depreciate it or you lower the value of it by 1/10, 1 year every year. But it's not cash. It's really just recognizing on your accounting books that the value of the building or the car is less than when you bought it, basically. The other point of depreciation is also the ideal is that you're taking that $2 in this case, very simple, or you can think of it as $2,000. You're setting aside that cash for when you need to replace that car, that you would have that cash ready to buy the new car in 10 years when you need to buy it. Because often if you waited until 10 years and, oh, I have to buy a car and you don't have the cash, then you have to borrow money again. And it's usually ideal to minimize borrowing as much as possible. We'll cover this a little bit more later too. And then taxes. Usually we, and somebody did mention taxes. I think the only thing I probably missed was insurance, rent. A lot of farmers here in Maine actually have to rent their land. Land, unfortunately, is being is difficult to find these days, and so a lot of farmers are renting. Taxes you often find at the bottom of the profit and loss because all of your expenses are typically what are called tax deductible. So you want to calculate your taxes on everything after all the other expenses so that you can minimize the amount of taxes that you pay. And so we have a total tax of expenses or cash spent out of 166. But one thing I wanted you all to think about is, and this is when we get into the concept of accrual accounting, is often when we purchase seeds and feed and even livestock, we're not going to use it all. And so sometimes there's some left over at the end of the season. And so in my example here, we have some seeds and feed of $20 or $20,000 that are left over. And at that moment, they're not an expense because you still have control of them. They're still in your barn. They haven't gone out the door or through the stomachs of your livestock. So just remember that when you purchase inventory or inputs, they're not necessarily expenses until they go out the door and the customers take them, or it's used up, like fuel. Like fuel is used up, but if you have it in a storage tank, that's actually still something that you own and control. We go to the next question. Oh, and just in this simple example, I just have a little note at the bottom. We are going to pay interest on a bank loan, but in our example, we're not going to pay any of the loan amount back. Typically, like folks like us, we would require you to pay some of it back in the first year, but in our example, to keep it simple, we're not going to. So now I want to ask you the question: how do we bought all these things? But how did we actually pay for it all throughout the year? What are different sources of or ways that we can purchase things? And this is a question to everybody, same thing, sort of popcorn. Credit, yep.
Credit card, account load.
Credit card on account, yep. Member dues, yep. Bank loan, capital campaign, yep. Perfect. Yeah, so we can go to the next. I think that's a good start. So in our example, so we have cash from reserves, which could be from the capital campaign, grant money, yep, and member dues. Often those things are often raised before you get started. So we've raised some cash from our sales. So we're going to get cash from our sales. They don't usually all come in at the same time. I saw somebody mention CSA. That is a form of sales. We have a farm with a little rental apartment on it. So we're going to earn some apartment rental income. We're going to call that other income, which is it's not core to our business. It's not core to our operations, but it's a nice little add-on to our operations and can help support our other operations. Suppliers and vendor credit, somebody mentioned that on account. So the folks who sell us feed and livestock and fuel often will give us 30 to 60 days to pay them back. And so we have a bunch of cash or sources of cash that have come in at 245. But we only spent or had expenses of around 166. Now remember, depreciation is not cash. So what the cash that we have left over in this example is we have 245 that's come in, 166 that's gone out, but we add back the $2 in depreciation because it's not actually cash going out the door. So remember that again when later when we're creating the balance sheet. This is not only are we building the profit and loss, there's always a tie-in profit and loss with the balance sheet. So remember that. You can go to the next slide. So we now have all the elements to create the profit and loss, and the basic equation. Sometimes income statements or profit and losses get complicated because of all the various chart of accounts that Rebecca mentioned. Sometimes I've seen income statements that can be 5 pages long, and boards and employees and other stakeholders can get overwhelmed just by the sheer volume of accounts. But really what it boils down to is income or revenue or sales coming in, less expenses, money going out usually, and that's in your net income or your profit or loss. Sometimes you will have a loss, particularly if you are a startup, you'll have a loss for the first couple of years. You would call that a net loss. That's the basic equation. And so in some cases, and for some stakeholders, you might have a very simple profit and loss that you would offer. And some of our partners even have what's just a 5-line income statement that they share with certain stakeholders. With others who are in the finance department or really looking at different operations or even a finance committee, you might have a much more detailed income statement that really just breaks out each of these categories, particularly income. You might have different sources of income, like the rent. Rebecca mentioned different departments, so you might have income by departments. And with expenses too, you might have the common expenses are the inputs that you have, your inventory that you spend, labor is big, utilities. So you may all roll that onto one, or to simplify those categories, or you might want to break them out. And I was wondering, Carolyn, could you help me with the question? Make sure I understand it fully in the chat.
Hey, Chris.
Yeah.
There's a question in the chat in Spanish. Sorry, I should turn off my interpretation. There's a question in the chat in Spanish. How do we account for the money that everybody puts in creating the co-op?
Yeah. So often, you know, it is a startup. Typically, the membership dues, we would probably consider that non-operating income. So whatever you plan to sell in the future. As a startup, usually what would happen is that and we'll actually talk about this. This is more of a balance sheet item where that's really considered membership equity. And we'll go into the equity reserves, and it is not exactly your typical revenue. So it's more of about building your balance sheet. But on the other side of that balance sheet, you are creating cash. So you do have that cash. It's usually unrestricted, meaning you can use it however you want to use it. So it can help you pay for some of those startup costs. But typically we wouldn't roll or consider membership payments in the usual profit and loss statement. It is considered, you know, in a lot of ways it would be considered income because it is money coming in. Probably would just consider it non-operating income. Just not your regular recurring income. Yeah, great question though. Thank you. Yeah, and the cash flows for startup will be very different, and your financial statements will look very different from a startup position versus, okay, now it's day one, we're starting to sell, we're starting to pay salaries. It will look very different. Yeah, so the basic elements of any financial statement we just wanted to cover. Usually they will tell you at the top, especially from QuickBooks. So we're kind of modeling this off kind of how QuickBooks looks. At the very top, it will tell you what is the statement. So it'll say the name of the company, thank you. The type of report, profit and loss or income statement. It will also tell you whether it's actual cash or accrual basis. And I'll go over that a little bit. The time period. So this one is a 12-month period, but you can actually do it in a day. QuickBooks can generate any time period you want. Generally, you wouldn't want to do any less than a day, like in the last hour. A lot of companies do figure out all their accounting at the end of the day or the end of the week. So usually a weekly report is common, but even more common is a monthly report. And then accrual or cash basis. So accrual, we wanted to cover that a little bit and why it's different than cash basis. So in the examples that we talked about, particularly for startups, is as you buy inventory or inputs, like I said, it's not always an expense until it leaves your business. So that's one difference with accrual, is you only accrue an expense when it goes out the door and in the moment that it leaves your door, and not necessarily when you spend that cash. The other big difference is when you make a sale. And I'll give you an example of a daycare that we're working with. A daycare here, it's a startup. They work with the state of Maine that pays for daycare for a lot of the kids. But they only get paid every 3 months. It's the government. So you can always count on them paying you, but you're never quite sure when they're going to pay you. So every day they provide a service to those kids and the parents, but they're not getting paid in cash from the state of Maine until 3 months from now. So you want to recognize the revenue because you're already doing the expenses. You can't wait. You can't ask your employees to wait 3 months to get paid. You can't wait 3 months to pay your taxes or your utility bills. So you have to recognize that revenue each day or every week because those expenses are happening. And you want to match your revenues with the expenses that are happening in that moment. And so that's a big difference of what accrual versus cash is. A lot of businesses will function in a cash way on a weekly or monthly or even sometimes a yearly basis. It really depends on when you work with your accountant or your bookkeeper, what works best for you. And sometimes you might make these adjustments from a cash basis to an accrual basis less frequently. It really depends on what your needs are and how best. Accrual is very helpful in helping pay for your taxes appropriately, though. You don't want to overpay, and you definitely don't want to underpay taxes, because then you can get into trouble. And then actual versus pro forma. Sometimes what you'll see, pro forma basically just means budget, and thinking about projecting out what will my budget be. You can project out your cash flow, or you can project out your basic accrual profit and loss. Often what you'll see, and QuickBooks can do this, is you can see actual what we did for this month, and then QuickBooks can calculate what your budget was for that month, and you can compare the two. And so you'll see that at the top of the report. So here's, so from the example that we used, we had total sales and revenue of $170. Now, in my simple assumption, we didn't have any sales on credit. So all of our customers paid cash, but in a lot of cases for you all, you'll have customers who will pay you on credit, say 30 to 45 days. Go to the next line. So cost of sales, this is a very common breakout. It's usually has to do with the precise inputs or inventory. So if you're a food co-op, or if you're a cake, you create cakes, or you're a farm, for a cake example, all of the different ingredients that you put into cakes and get the cakes out the door are what are called your cost of goods sold. And it's usually a good idea to break these out from your other expenses like utilities and labor, just to see kind of how you're doing just from a basic cost of goods that you sell. So in this example, this was all the seeds and feed. Now see the 90, we actually bought seeds, feeds, and livestock of 110. But remember at the season, we had 20 left over. So we're only costing out $90 here. Now, the subtraction of this will give what we call our gross profit. And basically, this is after your most basic cost. How much money do we have left over to pay all of our other administrative costs, labor, utilities, everything else? So we've rolled up all the other operating expenses into one line. You can certainly break out all these different lines. So in parentheses, we have labor, fuel, utilities, bank interest. But for the sake of simplicity, we rolled it up all into one. Often labor is broken out because it's often a really big line item. And that's usually what I recommend to folks is think about what are the biggest expenses that really drive the success of your business. So for things that are a couple $100 a year or only happen once or twice a year, it may not be worth breaking them all out in 10 different lines. But for things that are recurring and that are very large in relation to your overall operations, it might be worth having a separate line item for them. So after gross profit, we had $80 left over after our basic expenses. Now with our operating expenses of 50, now we have net income that's left over of $30. And this number not only kind of tells you what gain or profit we made, but it'll be important to remember this number for when we create the balance sheet as well. That will increase what are called retained earnings in our equity side of the balance sheet. And this is the primary number that ties the profit and loss to the balance sheet. I'm sorry, I jumped ahead. I forgot about other expenses, other rental. So we broke that out here because one thing that we like to do at the very top of the profit and loss is really focus on the core operations, the main activities, the reason that we exist, we are a farm. And so we wanted to focus on farm sales and farm related expenses, but we still get a little bit of income from our renter who lives on our property. So we're still going to include it in the profit and loss, but we're just going to provide it down lower so we can really focus on the main operations first and then see how the supplemental income is helping later. We also broke depreciation out because it's a non-cash item. We wanted to show that. And then here you have income before tax. And this is where it's important because it helps you calculate your taxes. So one advantage of expenses is the more expenses you have, although it doesn't help you in terms of having a nice gain or profit, it does help you reduce your taxes. So you're going to calculate all of your expenses against your revenues. And at this point is where you're going to calculate your taxes. And usually it's a certain rate. Your bookkeeper will help you calculate what your taxes are. I can't even think of the math, but it would be some kind of a percentage that your bookkeeper will tell you. And then your net profit. And this is really what you have at the end. And this is the number that's going to go to your balance sheet. I apologize, I jumped ahead. And so this is the number that will increase your retained earnings, or it could go down. You know, like I said, in the first couple of years, we're a startup, we may not have profits. So it might reduce your equity in the first couple of years. So that's the income statement. And I think really the difference is, like I said, is you might just want to break out, especially revenues. You might have departmental revenues, and you might break out different expenses a little bit more. The other thing is you might have different columns. So you might compare, you know, this is for 12 months. We might compare, this was 2022. We might put the profit and loss right next to us that is for 2021, for example, and see how we did. You might also put your 2022 budget here, profit and loss, and compare it budget to what we call actual. You might also want to put next in a column, you actually could look at sort of a cash basis profit and loss too. And some of the things that I mentioned were your depreciation item here is not a cash. You know, some of the inputs that you bought weren't exactly an expense from an accrual perspective because the seed and feed hasn't gone out the door yet. So you could kind of compare a cash basis as well. So that's basically it, and you can tell QuickBooks and other software to add these columns. You just have to make sure you input them, particularly your budget. So if you had your previous year in there, QuickBooks can pull it up automatically, but every year you will have to enter your new budget, and then it can compare the two next to each other. And I see one question, or how might it look different for different audiences? Yeah, and then for different audiences, you may just, like I mentioned, for departments, you might actually just have a profit and loss for your wholesale and a profit and loss for your retail. Or you might have different products. So we both sell vegetables here in this farm, but we also sell chickens. So we might break out the revenue lines here, but actually we might have a separate profit and loss for our chicken sales and our vegetable sales. I also wanted to, we also just wanted to point out sort of different ways of presenting a profit and losses. And a lot of times, a lot of companies break out how money comes in and how money goes out in terms of how you spend a dollar, 100 pennies. And so for the English speakers here, this is meant to kind of show you that even if you're not exactly feel fluent in the language of accounting and finance, a way to visualize your profit and loss in a way that's understandable to anybody no matter what language you speak. And so here you'll see how the dollar is broken out. And actually we have, quite a few clients who break it out by pennies, and how many pennies of each dollar that we earn in revenue is spent for different costs. So you see 15% in the top green part of our dollar is spent for our cost of goods sold, our inputs, our ingredients, or our feed and seed. Payroll, the blue part in the middle, 50%, and rent, marketing, all those things. And then our net profit is what's left over at the end. And this is a nice way. And sometimes you might not even present what's on the left. You might just present the dollar to certain stakeholders in showing them how things are spent. You can have just as interesting of a conversation with folks around this kind of a presentation, rather than a really detailed profit and loss that's 3 or 4 pages long. Yeah, and really wanted to kind of point out, and we talked about this a little bit earlier, but the reason we often do pull out cost of goods sold versus other expenses is usually cost of goods sold are directly tied to the creation, the production of whatever item you're selling. And for those of you who are service businesses, so media companies, technology companies, we have an insurance client, you probably won't have cost of goods sold because you're not creating a tangible, real, hard product that you can put in your hand and handing to a product. You're providing them a service or consulting. And so you won't have cost of goods sold. So that won't be an important item for you. It'll really be about your operating expenses. But the important part is to sort of see how are we doing just with our basic creation of our products. And when you do that, often what you can do is kind of create you have a profit and loss and a break-even point for what should we charge for our product by breaking out these the cost of goods sold. It often helps you set your prices. The other thing that's been really important, we talked about, is what can you add next to your profit and loss. And so different ways of comparing, compare your actual monthly profit and loss to what you budgeted for that month, how you did for the previous same month in April or June. And then often what you can do, especially when you start looking at percentages, is looking at industry standards. So one of the things that we know about our food co-op clients is we were talking about the gross profit. If you divide your gross profit amount by your revenues, we generally say that most food co-ops have about a 30% gross profit margin. And if you realize that, or better, that means you're doing pretty well. If you're less than that, you need to really look hard at the revenues that you're generating or the cost that you're paying, because you're a little bit under your peers in the industry. We'll go to the next slide.
So in the same way that we created the P&L together, we're gonna go through an exercise of just creating a balance sheet for our same farm here together. So if you guys want to throw into the chat or come off mute to brainstorm some big ticket items, some assets that we would need to get started with our farm business. Tractor. Those are expensive too. They're really expensive. Equipment, buildings. Yep. Things you want to jump in with? Johan, we can, yeah. Irrigation system. Yeah, that can cost a lot. Johan, you want to send us to the next slide? Or we've got, oh yeah, okay. So land and existing buildings we've got here. and tractor, barn, tools, and fencing. And so we can go on to the next slide, Johan. Oh, we're also going to figure out how to pay for this set of purchases. And you can brainstorm again if you want to throw something into the chat about how we're going to, sometimes how you pay for a big, loans, grants, how you pay for something big might be different than how you're paying for your operating expenses. Established line of credit. Yep. Yep. All right, good. We can go to the next slide, Johan. So we're gonna say we got a bank loan and a friends and family loan, and then equity that belongs to our farm business is going to cover a portion of it as well. And so this is basically our, the content of our balance sheet here are these items. And we can go to the next slide. And so really, like the P&L, same thing, regardless of how long the balance sheet is, how much detail is there in the balance sheet, it's this same simple equation of it's what your business owns, what your business owes other entities, and then what the business owes the owners, or what the owners have contributed to the business. That's the equity. And so unlike the P&L, which is representing changes over a period of time, the balance sheet is a snapshot in a single moment of time. If you see, Carolyn, can you? Oh, that's okay. If you see negative numbers on your balance sheet, that's a red flag that something's wrong. So you shouldn't have any negative numbers. Like, for example, if you have an asset, regardless of how old that asset is, how much depreciation that asset has experienced, it still should never go below 0 on your balance sheet. And the same with your liabilities. If you're seeing a negative number, it may be that it's been designated into the wrong account. And then again, those retained earnings that we saw, that Chris showed us on the P&L, the net at the very end, whether that's negative or positive, that then goes on to, it joins your balance sheet in the equity section of your balance sheet at the end of that period. All right, we can go on to the next slide. So we can, it's so magical the way you do it, unveiling the balance sheet here. So you can see we've put a little bit of depreciation on the land and buildings. We've slightly decreased their value. Your land is not going to be depreciated over time. Land just holds its value. It also won't it won't increase in value on your balance sheet either, unless it goes through a sale or something. But your buildings will have a depreciation schedule. And all of your assets that are, durable, that you're going to use for more than 1 year, they're each going to have a depreciation schedule, and they might be different. If you have something that's going to last 7 years versus 15 years versus your building, you might have on a 30-year depreciation schedule. And those are something your accountant will help you develop the depreciation schedule in each each year you'll take off that 1/7 or 1/15 or 1/30 or whatever it is. And you'll often be expecting to replace something like vehicles or equipment not that long after they're fully depreciated down. Hopefully not before they're fully depreciated down, but sometimes that happens too, because it's not a guarantee, it's just kind of a guesstimate of how long the asset will last. And then, do you want to show us those short-term liabilities too? Okay, great. So I want to mention that your short-term liabilities are those liabilities that you're going to pay off in the coming year, that they're going to be due in the coming year, and that your long-term liabilities are those that you're going to keep paying for beyond a year from now. But each long-term liability typically has a certain amount of that long-term liability that's going to be due in the next coming year. And that part is considered the current portion of your long-term liability. And that current portion goes under your short-term liabilities. So this is helpful as you kind of analyze, with your balance sheet, you might be using it to analyze, like, do we have enough money?
I do have, I don't know if I can bring in
If you
tomorrow.
have some, that'd be great, 'cause I
Okay.
love it. And
Yeah. Oops.
Will we have enough money coming in to cover the liabilities we know we have to pay in this coming year? You want to be considering that current portion of your long-term debt as well. And then you can see under the equity section, that's where your retained earnings will join the balance sheet right there under, you can see the green with 34. And I think that's it for this one.
Rebecca, I just wanted to add, actually, can we go back, John?
So Chris can add.
Yeah, I just wanted to add, in terms of usefulness and how, what you would present on a regular basis, a lot of these items on your balance sheet aren't going to change that much over the course of the year. So in your regular reporting, you may not cover a lot of this on a weekly or monthly basis. But what I would say, and maybe somebody can shout it out or type it in, is on this balance sheet, what are some items that are going to change quite frequently and you might want to monitor a little more closely? And in the title of current or long-term may help you decide kind of what do you need to watch a little more closely on a weekly or monthly basis. Anybody just shout it out. Cash, accounts payable. Yeah, absolutely. And supplies or your inventory. Those are things that you really want to watch really closely. Cash, especially your bank reconciliation when you need to take QuickBooks and compare it to your bank statement and make sure everything is aligned and is paid correctly, and that you have enough cash to pay payroll that's due in a couple of days. So that's something you really want to do, and you might even have like a cash report that you really want to focus on versus the next couple of weeks of expenses that are going out. And then depending on your business, like a food co-op, a lot of our food co-op businesses, they're monitoring inventory on a daily or weekly basis through barcoding and really making sure they have all the needed supplies. I know Daisy from Gardner Food Co-op is here. I know she and her team are constantly monitoring the inventory to make sure what's actually on the floor is what's in the books and that they have what they need. So you may, on a regular basis, you may be breaking out these items a little bit more and not focusing on the full balance sheet. Thanks, Rebecca. Sorry.
Chris, I think it's back to you anyway, so you get to take it away. Chris, you got to get off mute.
Of course, it had to happen once. Yeah, for retained earnings, we wanted to cover kind of why is it important? And really, retained earnings, one, is what's left over for the business, for your cooperative. And then it's really up to you to decide how are we going to use those retained earnings. And it's a matter of, you can leave those retained earnings in there as sort of a rainy day fund. I mentioned the depreciation concept of putting aside depreciation to eventually replace that car, that building that you'll have to replace eventually. Other things are you might want to set aside some training for your staff. You may have a plan to build a new building or launch a new product. And so you might want to retain those earnings for those different needs. But then also you have owners. And so you have what's the concept of patronage, of paying out some of those gains that you might have had a really good year this year. And so have your owners benefit from the economic gains of the cooperative. And it's really, you typically would want to have a general policy for what you do with retained earnings. And then each year, usually and often at the end of the year, the board will help the owners decide how are we going to use these retained earnings. But one thing we always caution is don't always just, if you have a net gain, we don't recommend sort of distributing it, every bit of it to the owners, because it's always nice to have a cash reserve, and you always have to think about maintenance for the next year, and you might have an extra purchase that you have to make. So you want to keep that balance.
Also, if there is a loss in a given year, if you have retained earnings, those can cover the loss so that individual owners aren't having to take a hit in a given year, which can be really helpful.
Good point, thanks. So the final report of the three, cash flow statement. And a lot of folks ask, well, is this not my income statement? The real big difference is that concept of accrual. What's the big difference is if you buy that inventory, but it hasn't left your store, then that you have paid cash, but it's not an expense because it hasn't left your possession yet. And then you've made a sale, but it's on credit. So you're keeping an account book of one of your members who says, hey, I need to buy these groceries, but I'm going to pay you back next week. Can you just make a note of it that I took $20 worth of groceries today, but I'll pay you next week. So that's really the difference. So there's no exchange of cash. So, but I still made the sale. And so I need to recognize that expense at the moment of the sale, even though I'll get my cash later. So a cash flow statement helps you really focus on, that one balance sheet item that we talked about, that change in cash. So this is probably the simplest equation of the three. It's really about what comes in as cash and what comes out of cash, and you get your ending balance. In this day and age, often one, you need to monitor it in your accounting system, but the other place to check this, most people don't keep cash on hand in their office or the store. So it'll be in your bank account. Your bank reconciliation is a way to monitor this as well. So there are three main categories in a cash flow statement. The first one is just those ongoing seasonal operations that happen. From a technical perspective, where we start with this is with the net income. Remember, we made $34 for the year. We're going to add back our depreciation because it wasn't cash. And then we're also going to look at some of the changes in some of our short-term accounts, particularly our accounts receivable. Did we allow any credit to folks? If we showed it as revenue, but we still haven't gotten paid, we can't count it as cash yet. And then supplies or inventory. We might have bought a lot of inventory, but it hasn't gone out the door yet, and we don't need to show it or we do need to show it as a cash, but it's not an expense yet. So this is telling you what my cash flow from my operations are, and this kind of gets the income statement back to a sort of a cash-based, not accrual-based statement. And then in the next category, we really get to more of the long-term aspects, those big long-term assets, the buildings, the equipment. And so the 655 is us buying all those big purchases. Once you get started up, you probably aren't going to have a lot of this happening. And then how did we pay for these big purchases is the next one. Cash flows from financing, our bank loan, our families and friends, and what we as the members put in the beginning with the 685. So these last two categories, cash flow from investing and cash flow from financing, you're probably only going to need to look at it once a year. It's really those cash flows from operations that you're really going to want to focus on, and it's that change in cash, but it and the changes in our inventory and our accounts receivable and our accounts payable that we really want to monitor on a weekly or monthly basis. But in the end, we do get a net change in cash, and when we add all of these three together, so we had a positive 51 from operations, a negative 655 from investing. It's not a negative thing because we had cash coming in from our financing of plus 685. So net, adding all three of those together gets our net change in cash for the year. This will often be something that your accountant or bookkeeper will do once a year. What you really want to be watching from a weekly or daily basis is really watching your bank account and that cash account in your QuickBooks or the software that you're using. But we wanted to cover it just so you all could see these numbers tie in and are relatable to the profit and loss and the balance sheet. So in the next month, we may actually cover both projections and a deeper dive into financial analysis. But we also just wanted to give you all some ideas of, often reports aren't very useful unless you do provide a little bit of analysis and some details around these financial reports. So it's often good to focus on offering a visual of what did we think we were going to do and then what we actually do and how close were we. Usually what you want to see is we did better than budget, not worse, but sometimes that happens and events happen. We had a little, COVID happened. So a lot of us, our budgets were blown out of the water. That happened when that happened, and we have to adjust. Agings, accounts receivable, especially if you offer credit to your customers, you want to dive into those accounts and see. There's a couple of things you want to look at. Is there one or two customers that are the biggest representation of your accounts receivable? Or is it spread out over over hundreds? And so you're not dependent on one customer in particular. And then also the aging, or how long has my accounts receivable been around? Are our customers paying us back the next day? Or are they paying us back 2 months from now? That could pose a problem. And then those comparison reports that we talked about, comparing yourselves to previous years, industry averages and competitors, and then breaking it down by department and product. And you can do that not only just on revenues, but you can also do expenses. You can tie that labor, tie that utility cost to a particular department or product. And that's basically it. We provided some more, and you all will get this presentation, I believe. So there are some links here to other webinars that you can refer back to. And as I mentioned, we probably will do a third part to this series covering financial analysis and projections or pro formas. I really enjoyed the last one. It's public. This is one of our customers, Belfast Food Co-op. At minute 15, they do a really good representation on sort of how their profit and loss looks on a penny basis. So 100 pennies represented on the slide, and they show sort of how all the expenses are paid out. So there's a lot of different ways you can present these examples. Yeah, and I think we'll end that here in terms of where we are, and maybe end a little early. But we basically have about 15 minutes left for questions and answers around creating these statements, but also in terms of how you present them to different stakeholders. And we're happy, all of us here, Rebecca, myself, Johan, Carolyn, and Maggie, are happy to have one-on-one conversations with you. I've done that with one of our customers recently, where they wanted to present for a particular department. It was a coffee roaster. They do wholesale and retail, and they wanted to do a representation for their employees in the retail cafe. Yeah, Lee asked to go back one slide, Johan. Thank you to EDC. And the recording will be coming later too, that you all can refer back to, but also share with others who can watch this. So these are just different webinars. Yeah. One thing that we can also help you think about is when you're doing comparisons to your industry, is we can help you perhaps find some industry data out there. In particular, we have a lot of information on food co-ops, but you could, yes, we'll definitely send the slide deck. Yeah. So any questions for us in free form, and not just for Rebecca or I, but to other folks at the Cooperative Fund or between cooperatives too. Does anybody have any thoughts on how, I know we've got quite a few folks who would normally be the presenters of these financial statements. Has anybody have any thoughts on how they might adapt some of these principles or change how you all might present these financial statements to different stakeholders?
If we're sending out paper for people to share, we'll often annotate it with, you know, with a yellow marker or something, and explain on literally over the number what it is and why we got there. And, you know, have like 5 or 6 of those yellow things, which say, look at this, look, and this is this, and this, these are the key things you need to understand. So they can see the whole thing, but you can really call out the key issues.
Absolutely, yeah, and you might want to think about formatting colors and things like that, and really like we were talking about, either in the balance sheet or the profit and loss, you could have 100 lines in your profit and loss, but really, like Corinne is saying, maybe for labor in particular, or for our utilities that have gone up 100% in the last month, we really want you guys to focus on these new numbers. And then we'll put everything else in a general miscellaneous expense bucket that we can talk about later, because that hasn't really changed that much. So there are different ways to emphasize. And I love that you provide definitions too, if you have the space, sort of both to focus on it, but also help describe what it is really helpful sometimes. Yeah, great. No problem, Jacqueline. Yeah, definitely feel free to ask your questions to us later too. Yeah.
Yeah, we're easy to get a hold of. There's no phone tree. Just ring our numbers and we're there on the other end of the line. So an email is great. So don't be shy about reaching out if you want help thinking through something or thinking through how to present something to others that you work with.
Thank you. That's very helpful.
Yeah, and then we have included the next, maybe save the date for now. We don't have the link yet for registration, but part 3 in the series will be July 27th at noon, same time. And in that, we'll do a deeper dive in financial analysis all kinds of ratios and thinking about how to do budgeting and projections.
Thank you, Corinne.
Yeah, thank you.
All right. With that, maybe we end today's session, right? I want to thank you all for being here. Hope you learned how to make a statement and make a statement that makes a statement. So just want to thank you all for being here again.
Thank you, everybody.